19.5, declining balance method of depreciation. One objective, you need to be able to calculate depreciation using the double declining balance method. So we've learned the straight line method, now we're looking at double declining balance method. Accelerated depreciation is any method of depreciation that records greater depreciation expense in the early years and then less depreciation expense in the later years. The declining balance method of depreciation is a type of accelerated depreciation that multiplies the book value of an asset by a constant depreciation rate to determine annual depreciation. So what we're looking at here is instead of a set number that it depreciates each year, it's a set rate that it depreciates each year. A declining balance rate that is 2 times the straight line rate is called the double declining balance method of depreciation. So to figure that out, what we're going to do is we're going to look at the estimated depreciation expense, which is going to be 100%. And then the years of estimated useful life is 5 years. When we divide those two, we get 20%. Now that would be the straight line rate, but we're looking at double rate. So we're going to take that straight line rate times 2 to get our double declining balance rate of depreciation. So what we're saying here is that the asset is going to depreciate 40% each year. So when we look at, what do we have here? We have an automobile, and the original cost was $30,000. Estimated salvage value is $2,500, and the useful life is 5. So we figured out, we took that 100% divided by 5 to give us 20%. Now double declining then would take that 20% times 2, which gives us our 40%. So we take $30,000, our beginning book value, times that rate of 40%, and that first year of annual depreciation is $12,000. That means after the first year, that car is worth $18,000. Again, when we look at the second year, we're going to look at that declining balance rate of 40% again. So that year, it will depreciate in value of $7,200, which ending book value after year 2 would be $10,800. We see this a lot in automobiles. They're going to depreciate more in the beginning, and the amount will depreciate less as the years go on. Okay, so this is then just the amount or the whole depreciation for the life of that. So we have 5 years. Now notice when we get to that last year, we don't put that rate in, because when we look, we see our salvage value is $2,500. So we know our ending book value has to be $2,500. So that annual depreciation for that last year is simply going to be $1,388. We look at our total depreciation for all 5 years, which would be $27,500. The double declining balance method of depreciation is one method of accelerated depreciation. Remember, accelerated depreciation is when it depreciates more at the beginning and then depreciates less as the years go on. All accelerated methods have one thing in common: more depreciation is charged in the first year than in the later years. GAAP, remember, generally accepted accounting principles, allows each business to choose either straight line or accelerated depreciation for financial reporting. But once we choose, that business needs to use the same method from year to year. They can't go from straight line to then double declining or vice versa. Once they choose that method, they have to stick with that method. Modified Accelerated Cost Recovery System, MACRS. The United States Internal Revenue Services, the IRS, has published rules that must be applied when calculating the amount of depreciation expense that is used to compute a business's federal income tax obligation. Those rules are called the Modified Accelerated Cost Recovery Systems. MACRS is an accelerated depreciation method. Here they're just showing us what it looks like compared from straight line method, which we learned before, to our double declining. So notice the amounts are going to be different for that annual depreciation. However, the total depreciation is going to be the same. The ending book value is going to be the same. The only difference is how much it depreciates each year. Number 1, when calculating depreciation expense using the declining balance method, what number stays constant each fiscal period? The depreciation rate is always going to stay the same. Number 2, what is the declining balance method that uses twice the straight line rate? That would be double declining balance method. Number 3, what change occurs in the annual depreciation expense calculated using the declining balance method? The depreciation expenses is going to decline each year, and the most expensive depreciation will be the first year, and then it will go down after that. And the last one, number 4, an asset is never depreciated below what amount? It will never be depreciated under the estimated salvage value. That was the end of 19.5 lecture. Now watch the 19.5 work together.